and welcome to Macros with Mythili, our weekly program where we take a hard look at all the major macroeconomic issues and developments in India and overseas. Well, this week we're going to take a hard look at two major developments that are on the economic horizon. And joining me from Washington to help us do that is noted economist Eswar Prasad, Senior Professor of Trade Policy, Cornell University, and Senior Fellow, Brookings Institution. Welcome to the show, Eswar. Well, you just returned from China, Eswar. So can you really tell us what exactly is going on there? How real is the slowdown? Are the fears of the world imaginary?
Now, the Chinese economy is definitely slowing from its pace even last year. The government still maintains that it can reach growth of somewhere in the range of 6.5% to 7% this year, but it's going to be a challenge. And one of the reasons why there is so much concern about the Chinese economy is that many of the indicators that we get to see are about the manufacturing sector. So if you look at freight volumes, electricity consumption, purchasing managers index, all of these are about the manufacturing sector, which has been doing quite badly. Now, what the Chinese government maintains is that if you look at broader indicators such as the services sector and consumption, those are doing a lot better, and they argue that these should be enough to prop up the economy in the latter half of the year. Now, the economy, of course, has been hit by two sources of volatility in recent months. One was the very significant decline in the stock market. Now, of course, the stock market has fallen very sharply, and it's down slightly below the levels it was at the beginning of this year. But last year there was a very dramatic run-up in stocks. So if you bought Chinese stocks, or at least the major stock market index, in July of 2014, you're still actually making a bit of money. So one has to keep that in perspective. But that has added to a lot of concern that the Chinese government is not able to manage the financial markets in particular. Then a few weeks ago, the Chinese decided to allow their currency's value to be more market determined, and they started off with a 2% devaluation, but it wasn't well communicated, so the market misinterpreted that as a panicky move to support the economy. Now, the important thing to note is that China still has a lot of room in terms of monetary policy and fiscal policy. The explicit government budget deficit at the central level is only about 2.3% of GDP. There is still room in terms of interest rate movements. So there is a sense that the Chinese government could do more to prop up growth, but it's going to be a difficult slog. So almost certainly the economy is facing a difficult time, and I think that's going to have spillover effects on the rest of the world.
There are reports that China has lost a large amount of reserves, over 93 billion in August alone, and in the year as a whole, 444 billion. That's more than our entire reserves. Is this on account of intervention in the market, or because portfolio investors have turned tail and left China?
Now, the Chinese government is going through this very complicated and somewhat schizophrenic attitude towards letting the market sort of discipline itself versus trying to control the market. So when the Chinese stock market rose as rapidly as it did last year, there were some in the Chinese government who were actually encouraging that upward move, because at a time when the economy was beginning to slow a little bit, a rising stock market meant that consumers felt wealthier and they were consuming more. It was also a good channel for firms to get finance rather than through the banking system. And that was the real problem, that they didn't take measures to control the huge upsurge in the stock market. On the way down, they've sort of whipsawed between saying that the market needs to find its own bottom and recognizing that if the market were to plunge too sharply, it could cause concerns about their ability to manage the economy and also increase opposition to the sort of financial market reforms they've been undertaking. And this has actually made things worse, because they've gone in and intervened to some extent and then pulled back. So the market is very confused about exactly what their intentions are, and clearly there has been a significant communications problem as well, because the government, in my view, has not done a good job of communicating exactly what its intentions are. It seems to want to let the market discipline itself, but occasionally goes into intervene, and that, I think, just increases volatility substantially.
The fall in the stock market in China has been fairly dramatic, but since mainland stock markets are mostly populated by domestic investors, this should not really have any consequences for capital flows. Yet there is a belief in India that capital flows coming out of China will automatically result in flows into India. Is this a misplaced faith, misplaced optimism?
Now, a lot of the money in the Chinese stock market is really domestic money. The presence of foreign investors is important at the margin, but they still don't play a very big role in terms of the overall Chinese stock market. But having said that, there is a fair amount of capital flowing out of China, not just foreign investors putting less into China or even pulling out a little bit from the equity market, but Chinese citizens taking money out. And part of this is for good reasons, because a lot of the savings in China, and China overall saves nearly half of GDP if you put together household, corporate and government saving. So a lot of this investment is trying to find an alternative investment opportunity, and households and corporations reasonably enough are trying to diversify their portfolios. But also there is some concern about where the Chinese economy is going, what might happen to the value of the Chinese currency, the renminbi, and that I think is stoking some additional outflows. Now, it's not obvious that a lot of this money is going to go to India, because Chinese money coming out of China is probably looking for good diversification opportunities and trying to find safer investments, especially in the advanced economy, equity and bond markets. And a lot of the foreign investor pullback from China, I think, is a global rebalancing of portfolios in anticipation of a rate hike by the Federal Reserve, the US Federal Reserve, either later this year or early next year. And so I don't see India as benefiting very greatly from these outflows, but at the margin, among the emerging markets, certainly India looks in much better shape than most other emerging markets. So if there is money still looking to go to emerging markets as an asset class, I think India could benefit, given its relatively stronger fundamentals compared to other emerging market economies, most of which are doing pretty badly right now.
Is the renminbi correctly valued, or is there still scope for further depreciation, and what would be the consequences of that?
What we know and what we economists know about exchange rate is really what drives them in the long run. In the long run, productivity growth tends to matter a lot more. In the short run, of course, those can be overwhelmed by capital flow dynamics. And as I said, given the amount of captive savings within the Chinese economy, having even 10% of those savings leave the Chinese banking system, for instance, and move out of the country, again for very good reasons, for reasons of diversification, can put significant downward pressure on the yuan's value. Now, the big issue, of course, is it's very difficult to separate out capital flows for the right reasons from capital flows that may be taking place because of concerns about the Chinese economy. And certainly some of the capital outflows are also because of the anti-corruption drive, because certain very wealthy and influential people are taking money out of the country so that they can protect their assets from the anti-corruption drive. So all of this is happening at the same time that the Chinese economy is weakening. So certainly, if they were to use the greater flexibility in the currency, it could well be the case that the renminbi still drops further relative to the dollar. But again, on a trade-weighted basis, the interesting thing is that even after August 11th, the renminbi has stayed flat relative to its trade-weighted basket, because while the renminbi has depreciated against the dollar has continued appreciating. So relative to its other trading partner currencies, the Chinese renminbi is still not that weak.
Eswar, now let me take you back a little to the period before the global financial crisis, when one of the reasons advanced for the global crisis was what Western economists call the savings glut in countries like China, driven essentially by undervalued currency. In fact, the US had put enormous pressure on China to revalue its currency. Now, when it appears that China has been a good boy and done whatever the West wanted it to do, and the currency has appreciated even more than was warranted by its fundamentals, the West is unhappy about China trying to get its currency to reflect its underlying fundamentals. Does it seem that, as in the past, the US is once again forcing the rest of the world to take the pain of adjustment, just as it did with the Plaza Accord, when the US currency was deliberately made cheaper relative to the Japanese yen and then had to be followed by another accord to ensure greater stability in exchange rates in the world?
From the US point of view, especially for the US administration, it's created this curious dilemma, because it's hard to tell the Chinese government right now to stop doing what the US government had been asking them to do, which is to allow the currency to be more market determined. Now the problem is that in the US, presidential election politics are kicking into high gear, and there is a sense that China is doing something that must be wrong. So congressmen from both sides of the aisle, from the Republican Party and the Democratic Party, have been saying that something should be done to prevent China from manipulating its currency. But as you've pointed out, the irony here is that China is right now intervening in the foreign exchange market to prevent its currency from depreciating, not from appreciating. So if they did allow the currency to depreciate, it would become even more competitive. But I think this is ultimately a good reform for the Chinese economy, because having a more market-determined currency will free up monetary policy to attain domestic objectives. And ultimately, I think this is better for the international monetary system. But with the currency of such a large economy having been maintained relatively stable relative to the dollar for so long, it's going to create a lot more volatility in both currencies and capital flows as markets get used to the currency, to the Chinese currency becoming more volatile.
The US and China are in some ways locked in a fatal embrace. China holds a very significant part of its forex reserves in US Treasury bills, and if it really begins to sell those bills in a big way, that could push up yields in the US at a time when the Fed is already poised to raise rates. Is there a sense of what this could mean really in the US amongst the policymakers?
Now, there has been some concern, because just today the report came out that in August, the Chinese had lost about $90 billion worth of reserves while trying to prop up their currency. Certainly, given the amount of US treasuries that China holds, which officially are something like $1.2 trillion, but in reality are probably significantly larger, that could have an effect on the US Treasury market. But the reality is that even as China might be drawing down some of its reserves, a couple of things are happening in the US. First of all, the US government's borrowing requirements are down quite sharply, so it doesn't need as much external financing from the rest of the world. And second, given all the turmoil in the world, partly caused by fear of what would happen with a Fed rate hike, and partly because of fear on account of what is happening in China, I think safe haven inflows, that is money in search of a safe place to hide from the global financial market turmoil, is coming to the US, is coming to the longer end of the yield curve. So in fact, despite the reasonable prospect that the Fed might start its rate hike cycle sometime this fall, in fact the yield on the benchmark 10-year Treasury is still hovering somewhere around 2%. So at least so far it doesn't seem to have had a big effect. And I think that it's such a big and liquid market that unless China were to liquidate a very large amount of treasuries, it's not likely to have a huge impact on the US bond market.
The economic problems in China are also likely to have a political fallout. Should the rest of the world really start beginning to fear the consequences of political stability in China?
There is some concern about what effect the stock market and currency market volatility will have on two things. Number one, the confidence of Chinese consumers, because if they get concerned about the state of the economy, that could in turn affect their consumption growth, which would have to be made up by investment growth, which would certainly not be good for the economy in the long run. And the second is the concern about Chinese citizens feeling that the government is not doing a good job of managing the economy. And the latter is a big concern, because the government, for all the turmoil that is going on right now, is trying to steer the economy in the right direction with some financial market reforms at least. So they have liberalized interest rates almost completely, with just a couple of steps left. They're trying to liberalize the foreign exchange markets. They put in place an explicit deposit insurance system. But the problem is that none of the other reforms in the real part of the economy such as state enterprise reform or labor market reform to allow freer mobility of labor by reducing the burden of the household registration system that limits interprovincial mobility. None of those are moving. And if the government is seen as having mismanaged financial market reform, that would erode both the political support as well as the economic space to undertake those equally important reforms. So I think this could have a fairly serious effect on the reform agenda and the reform momentum, and that may not have a big effect on short-term growth, but will certainly affect the Chinese economy's sustainable growth and therefore the world economy in the longer term.
Well, I'll come back to that question a little later in the show, Eswar, but it's now time for us to slip into a very short break. But please do stay with us. We'll be back very soon. Welcome back. You're watching Macros with Mythili, and we're discussing the two major developments that are on the economic radar at the moment, the Fed rate hike and the slowdown in China, with noted economist Eswar Prasad from Washington. Let me now shift to the US economy and the proposed Fed action. What is your sense of when the Fed will act? September? December? Or can it really wait till 2016, given that you do have US presidential elections in 2016?
That's a very difficult question for the Federal Reserve members, because what we've seen so far in terms of economic conditions in the US all suggest that the economy is continuing to post a relatively strong recovery. GDP growth in the last quarter was very strong, nearly 3.7% at an annual rate relative to the previous quarter. The latest labor market numbers suggest that the economy continues to generate roughly 200,000 jobs per month, and the unemployment rate is down to 5.1%. But the curious paradox here again is that although there are some incipient signs of wage pressures, inflation is still very well contained, and the price of oil remains weak, which also means that there aren't inflationary pressures coming from that side. So I think the Fed is in a real quandary right now, because the indicators about the US markets all suggest that the economy is on a path to a sound recovery, although again there are some weaknesses in certain sectors of the economy. But at the same time, there is a world out there that seems to be in turmoil, partly because of China, partly because of the other emerging markets that are not doing so well. Japan's economy contracted in the last quarter. The Eurozone economy barely grew. So in this context, if the Fed were to hike rates, that could have significant effects on emerging markets in particular, but certain other economies as well, and create a lot more turmoil in capital flow and currency markets. Now, typically Federal Reserve officials don't pay that much attention to what is happening in the rest of the world, but I think this is an interesting juncture where the Fed is paying a lot more attention. And at some level, some tightening has already taken place in the US because of the increase in the value of the dollar relative to every other currency in the world. It's appreciated over the last year. So that's already created some implicit tightening and has affected corporate profits of multinationals that have a lot of operations abroad. So right now it's a really tough call. Most Fed governors have signaled that they would like to start the rate hike cycle sometime this year, but whether it happens in September or December, I think the odds are still roughly 50-50.
What, to your mind, should be the bigger cause for worry as far as India is concerned? The US Fed hike or the slowdown in China?
I think among the emerging markets, India is in a somewhat better position because with the rupee where it is, and I think the Reserve Bank is not going to have that much difficulty holding the line roughly at that level. And with about $350 billion in reserves, and with the economy looking quite good compared to virtually every other major economy in the world, I think India is a little less vulnerable. But having said that, if a Fed rate hike does cause turmoil in the other emerging markets, and it does cause international investors to rebalance their portfolios away from emerging markets as a class, certainly India could feel some of the effects as well. I think the slowdown in China is likely to have less direct effect on India, given that India's exports to China are not that large, and the secondary effects are also not likely to be very big. But again, even though the Indian economy is less open to global trade and finance and some of the other emerging markets out there, India cannot remain isolated, and if there is a very significant rebalancing of global portfolios by international investors, or very significant spillover effects from this combination of a Fed rate hike and China slowing on other emerging markets around the world, that could certainly start having an effect on India and drag down growth to some extent. But I think in India, the issue really is still about whether India can get its act together in terms of the reforms that are needed to keep the economy on a track to strong growth. And if we don't see that happening, I think that could add to some vulnerability of India as well. But among the emerging markets, I think India is somewhat better positioned than most other emerging markets to withstand these two shocks, the Chinese slowdown as well as the Fed rate hike.
If, as you say, the Fed is likely to raise interest rates this year, India will either have to maintain status quo or hike rates to deal with the consequences, because capital will definitely flow out of the country. In such a scenario, would you say that we've lost an opportunity to cut rates?
Now, my sense is that the Fed's rate hike seems to be so well anticipated, at least in terms of its happening, although the timing is not clear. I don't think there's going to be an enormous amount of outflows from the emerging markets in addition to what we've already seen. I've spoken to government officials from many other Asian emerging markets, including Thailand, Malaysia, and so on, which took a big hit right now when we had this volatility on account of China. But even earlier in the year, there was a sense that a lot of capital that would have flown out on account of a US Fed rate hike had already left the country. So in many of these countries, the sense was they would much rather see the Fed get on with it, so that at least you wouldn't have this uncertainty adding to further market volatility. So my sense is that from India's point of view, there isn't going to be a huge amount of outflows unless, again, the Fed move turns out to be larger than anticipated, and if that creates a major stir in financial markets. But I think given how much anticipation there is about the Fed rate hike, given that what is happening in China already seems to be baked into markets to some extent, I don't anticipate a great deal of turmoil. And I think India has a little bit of room to let its currency take on some of the burden of adjustment in the short run. So I think a rate hike, unless there is major turmoil, probably won't be called for.
And lastly, let me ask you, Eswar, what is your outlook for commodities, and how can India best use that windfall?
It's hard to see commodities, especially oil, coming back strongly anytime soon. There is this very strong supply effect from new production in the US in particular. But in addition, the demand side is very, very soft right now. Other than the US economy, there isn't much strength in the advanced economy world, and most emerging markets seem to be doing terribly. And I think China's contribution to the growth in consumption demand is going to be very weak. Again, partly for the wrong reasons, because the manufacturing sector is slowing down very sharply, and partly for the right reasons, that China is very, very gradually moving in the right direction towards a dependence on investment-heavy growth or manufacturing sector-led growth towards more services-led growth. So that secular change was in train already. But I think given the enormous weakness around the world, it's hard to see, barring some major shock in the Middle East, for instance, commodities in general, but oil in particular, rebounding anytime soon. So I think this window of opportunity for India with low oil prices creating a favorable environment both externally and domestically still remains. So the big challenge in India is still to use this window to get going on the reforms the country really needs. And I wish there was more progress on that front.
Well, I'm afraid that's all the time we have in this edition of Macros with Mythili. Thank you so much each for taking time out to share your views with us, and most important of all, for telling us that India is in a relatively sweet spot and we don't have very much to worry either from the Fed rate hike or from the slowdown in China. Thank you also for watching, but we'll be back next week with yet another edition of Macros with Mythili. Till then, it's thank you and goodbye from all of us at ET Now.
Find us on Facebook at facebook.com/ETNow and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.